Morning, ladies and gentlemen. Akim is not an easy act to follow because one person that likes to put economists rooted on their feet. As economists like to, abstract significantly from reality. Thank you, the very distinguished Akim Mohammed. My job is not hard, but I will try as much as possible to simplify the economist's thought in simple language, because I know it's a room filled with businessmen and they don't like abstraction from reality. And who's going to help me with this slide movement? Are you going to? So before we get to the slide movement, I will do a bit of digression in history of economic thought, taking a cue from what Akim did mention, particularly the trade war. And the trade war, can be situated in that very beginning of the Bretton Woods. If you know what the Bretton Woods mean, the World Bank and the IMF. The World Bank essentially to help with development finance for countries, and of course, IMF for balance of payment equilibrium. And the whole trade war is essentially about balance of payment issue, whereby one country is exporting, another country is importing. And when you are exporting and I'm taking your goods, essentially what it means is that I'm getting money, and when you are importing, my pocket is getting looser. And the implication of that is what Trump is against. And he's saying that China fundamentally should not be allowed to grow by exporting, while other countries import leakages in their own pocket, and China has to change that course. But beyond all of that is that same economic policy, essentially, that was granted Japan and Germany after the Second World War, rigged currency, export-led economic model. The same economic policy was granted the Asian tigers, South Korea, Taiwan, Hong Kong, Malaysia, and they did that same thing, WTO monitoring that scenario. Then China also given that concession. And it always happens with the situation of imitation, invention, innovation. And Japanese goods, 70s, 60s, were considered fake. Eventually, they became hallmark. South Korean goods, Taiwanese goods, Chinese goods, fake imitation, but they've left that imitation. They've gone to invention. They're now innovating. 5G, AI, and that is the canal of the Trump war against China, because it fundamentally changes the dynamics of the global economy. And we at FSDH also are very conversant with the AI phenomena. And we are playing a catch-up, getting ready for it. So that's a digression. And that is the global economy, if I can go to the second slide. And you can see, essentially, the tariff war. Since 1800, partition of Africa, First World War, Second World War, it's always issue about trade. Germany went to war, the Second World War, First World War, because of balance of payment problem. IMF was created to make sure that we will never get to that situation whereby we'll go to war again. And Trump has come using the American might, the biggest, the largest economy, the most militarily strong economy, and practically telling everybody it's no longer going to be business as usual. And there was a lull in that activity in terms of the trade war. Of course, Israel bombed Iran right on the soil. Iran retaliated, oil escalated, the Strait of Hormuz. There was a threat that 25% of crude oil that flows through that area is going to impact crude oil prices. At FSD, we were excited that, eventually, external reserves will grow, because whenever there's war, it sounds bad, but whenever there's war, crude oil price escalates, and Nigeria benefits. External reserves grows. Other countries suffer. But it's not a balanced world anyway. We have the way we suffer as well. But it didn't last, because for one reason or the other, America got involved, bombed, heavy bombing, ghost, they called bombing, and everybody went back and calmed down. Appeared as if everything is over. About yesterday, day before yesterday, Houthi rebels working in Yemen, working for Iran, you can't actually say, bombed a Liberian flag, Greek-owned ship at the Red Sea. Now, Israel has retaliated again, going right inside Yemen and bombing right inside Yemen. But what it says in all of this is that, we can go to the next slide, please, is that Nigeria, from the global perspective, faces significant risk. But we'll get to that risk, and how that risk fundamentally impacts external reserves, impacts exchange rate stability, impacts inflation rates, ultimately monetary policy response, which will impact interest rates, and ultimately cost of fund for the business sector, cost of fund, even for the financial market, and opportunities in terms of assets to be acquired along that process. So let's keep on going, because we've essentially spoken about the IMF. I had to take us back into the journey. So nothing is new under the sky, basically. It is same old, if I'm allowed to say that. Dominance of the global space. Who are the guys, the dominant players? China is dominant. China's displaced the whole of Europe, displaced Japan, is now the second largest economy. America is the biggest economy. It's not going to just fold its hands and allow China to overtake it. It's got to respond. It's got to stop China from moving. The consequences of that is that commodity prices, given the size of China, given the capacity of China, please hold on here, in terms of manufacturing, in terms of demand for commodities. So we'll focus on demand for commodity because that's where it concerns us, so we can narrow back to Nigeria, home. And demand for primary commodities, essentially crude oil, and the importance of crude oil for us, because crude oil is essentially a situation whereby the federal government or the Federation of Nigeria, which is the federal government, the state government, and the local government, sell crude oil. They get dollars. The Central Bank of Nigeria buys that dollar from them, gives them naira. They share it at FAC distribution. So whatever happens to crude oil ultimately impacts the economy. So regional growth shows signs of fragility. Africa, to benefit. Let's keep on moving. Same old story from the global perspective. We're all aware about inflation rate escalated, kept going up globally. Monetary policy responses, including the Federal Reserve, the Bank of England, the Bank of Japan, the European Central Bank, naturally is to respond by higher interest rates. But we're all hoping, given the trajectory of inflation rate coming down, that they will all begin to slow down slow down the policy rates. But all of a sudden, it escalated, and they had to wait and see because of the Trump tariff war. Just about 2 days ago, Trump also further imposed 25% tariff on South Korea and on Japan. And I told you earlier on that South Korea and Japan were the Asian, Japan from whole school, Germany, Second World War, South Korea, from the Asian tigers, still copying that export-led economic model. And crude oil, so we've seen that escalation, like I mentioned, we saw a situation of economic outlook because of OPEC, because of Trump trade war and impact on commodity demand. And OPEC also, Nigeria is a member of OPEC, but Saudi Arabia is saying that they will not go Nigeria's route. And Saudi Arabia is saying that because they're losing market share and the agreement for them to cut output. Because OPEC is a cartel. And a cartel means that they can oligopoly. What it means is that they can only influence price, they can achieve the objective either to control price or output. If they control price, it will be too obvious, so they take output. And Saudi Arabia is saying no, that they will begin to release more crude oil into the market. Of course, when there's higher supply, demand will fall. Please can we move to the next slide? And these are the countries in the cartel that have said they will begin to increase oil output. An implication of all of this, next slide, is that, like I mentioned, external reserve, which is the basis on which the naira stability hangs, depends on what happens to crude oil. Now, the path for crude oil as a commodity is that as the tariff war goes on, the world or global economy will slow down because of less demand for crude oil. The implication of that is that the budgeted crude oil output and the price are impacted, which means that external reserves capacity of Nigeria to defend the currency will become harder. Ultimately, that will impact fiscal policy, that will impact monetary policy. But in all of that, risk from geopolitical environment, Nigeria has done significant spade work, like Akim Ahmed did mention. And we'll get to that spade work. That significantly insulates Nigeria from that global economic environment that is bringing with it risk. Please, let's go on, please. Can we go to the next slide, please? So this is the dollar, global currency performance. So there's significant global risk. Let's just go on so that we can go into the meat because of time that we have. We've talked about instability, Strait of Hormuz, Iran war. Israel has started bombing Yemen again. Possibility of tariff, war escalating. Trump has said that the tariff will begin to be implemented by July 9. He's moved it again to August 1. So with some negotiations still ongoing. Just playing the game, just playing that global leader game. Let's just move on so we can go to the domestic environment. Let's move on, please. Thank you. So how will the recent global developments affect Nigeria? Next slide, please. So this is the situation. Like I mentioned, Nigeria, since the return of the new administration, things are not done normally like we used to do them. And one of them is to first engage in fiscal policy reform, which includes the tax reform, which the tax expert from PwC has earlier introduced will come to dwell further on. Another one is monetary policy reforms, which brought pain, which still brings pain, but ultimately setting the tone for a more robust economy, for an economy that's able and capable to withstand global shocks. And I will get into those modalities of how we've been able to achieve that and how we'll be insulated from the global shocks that I've identified earlier on, coming from commodity price fluctuations, downward trajectory, as estimated by everybody, including the IMF and the World Bank. It's also good to know that the multilateral institutions, independent agencies, are giving the government, particularly claps, in terms of the reforms they've done, even though they're painful, but they're necessary. And we will see how that will help to insulate us. But you can also see from this graph, please, the previous graph, that there's a deliberate attempt to diversify the economy away from crude oil in terms of fiscal receipts of government. Like I did mention earlier on, whatever happens to external reserve, whatever happens to crude oil, because that is where we get the significant receipts to fund government activities, to fund the fiscal activities of government. And ultimately, because of the role of the central bank as a monetary and exchange rate agent to use to defend the currency and the cost of fund management in the system. So let's go on. Let's go on, please. So fiscal sustainability, like I did mention, I'm just trying to avoid the situation where I read all through the slide, but I believe that we have the slides with us so that we can run the time. And so when we look at all of that, and the impact on Nigeria is essentially through the oil channel, which is meeting revenue projections, and how do we achieve that? But what has happened is that we know that one part of the fiscal measure was to remove the subsidy on PMS, which is premium motor spirits. And the implication of that is that about 2.6% of GDP. If you look at that quantum volume of cash that's available to government, and that people have been asking that why are we not seeing that money being in the system, or that money, flowing around? But there was, some hire of NNPC, and eventually 50% of that saving have started to come into the system from January, and as time goes on, they're going to increase the volume that comes into the market. And in all of my talk so far is to try to tell us that Nigeria is in a better place than it is in 2022 compared to 2024. And that space and that place we are is where we want to partner with you, is where we want to try to talk you through so you can know that there are opportunities, like we all know, like everybody say, the potential is huge, the potential is enormous. Okay, this is off. And I just try to use my... Okay, it's back. Okay, let's go on, please. Let's try and speed it up. I'll let you know when to stop. Okay, so we've talked about finance, but fiscal policy, turning global uncertainty into opportunities. There's diversification of the economy. Like we say, we used to see fiscal receipts of government move from about 85% to about 62% in recent years. And that shows that there's fiscal consolidation, there's fiscal discipline. What has also happened with that, the devaluation of the currency in June 2020, 2023, saw a situation whereby the state governments receive more money, despite the exchange rate's impact. And what has happened is that with that, what it means is that the state have more money to spend than they used to have. And we can see that saving happen in terms of government borrowing. Because after the Central Bank of Nigeria securitized the ways and means that we all knew was part of the previous government, and the federal government deficits, debt ballooned, we've seen a situation whereby government has significantly reduced that debt in terms of maturities, in terms of what they're willing to borrow, whether through treasury bills, whether through OMO, whether through bonds. We've seen that fiscal discipline, and that fiscal discipline is what's going to help us, to survive the risk from the global economy. Can we go to the next page, please? So how have key macroeconomic indicators fared so far in 2025? Next page, please. For the real sector, the rebased GDP will be out sometimes in July. But what we've said is that leading indicators that define economic activities of why FSDH should be ready, willing to partner with you, why should I even come and invest? What are the opportunities? Are there opportunities? There are opportunities because you can see that the PMI figures, the producers, purchasers, managers index, that is the leading indicator before we get the GDP figure. Economic activities are on and are robust and are growing in the Nigerian economy. Opportunities to grow, opportunities to invest do exist. And you can see all of that. Next page, please. Now, this is a topical issue, which is the consumer price index, because this is ultimately tied to the interest rate environment. And of course, interest rate, I'm sure you want to know at what rate will you be borrowing in the next 4 months, the next 5 months, in the next 6 months. Is this sustainable? Is it going to, should I take it now? Should I borrow later? And is it a good time to borrow, or is it a good time, to purchase FX so that I can insulate myself from possibility of volatility or depreciation in the future? And I will go into that section of the report. And the inflation rate has seen a consistent decline since the rebasing of the rebasing of the inflation figure. You may argue and say, why should they rebase it? But it's allowed. It's allowed because the economy has grown. The size, the composition has grown. And we're seeing a decline, but we're going to see a little bit of spike in June because of the resurgence of the problems in Benue and Plateau region, which has been curtailed to a large extent. So the path of inflation is going down. And why is this very important? This is important because, can we go to the next slide? It's important because the monetary policy of the Central Bank of Nigeria, which is the central bank organ responsible for setting interest rates that will determine how much you will borrow or how much FSDH will be willing to, lend you money, is anchored on inflation targeting. And what inflation targeting does, essentially, is to say that my interest rate will move in tandem or in agreement or the way inflation rate move. So everybody knows what the game is. So if inflation rate has a tendency to go down for the rest of the year, implication is that interest rates are going to, follow suit. And we've not had such policy coordination, such transparency for us to be able to determine the path of interest rate until the recent time. But it's clear that interest rates are going to decrease in the foreseeable future than increase. I will not use the word ceteris paribus to play safe. But things can do happen. But by all things being equal, there's a tendency for inflation rate to go down, interest rate to go down. Another key element is external reserves and exchange rate composition. So by implication, what has happened is that the Central Bank of Nigeria moved away fundamentally from the Emefiele-led central bank. And what they did is to play on what we call the impossible trinity in economics. And what that means simply is that every country must choose two out of these three. You must choose fixed exchange rate, you must choose out of fixed exchange rate, independent monetary policy, and capital control. Emefiele chose essentially fixed exchange rate. The naira was pegged. Naira was defended by external reserves, and of course, independent monetary policy, which means that the central bank can determine interest rate part, and said no, nobody can spend that dollar card. You can't move dollar out, which was capital control. But the new government, what they did was to rejig that impossible trinity, because you can't choose the three, you must choose two. And said, okay, we will not do fixed exchange rate. Naira should float relatively. We'll have independent monetary policy, but there will not be capital control. Money can move in, money can move out. And we saw significant boosts in external reserves, and we saw a situation whereby external reserves net balance was about $4 billion, about $23–24 billion now, which also indicates that we will see stability in the currency into the future. But do not mix it up. A high currency is not an unstable currency in terms of exchange rate. It's the volatility of that movement that the central bank is concerned about. Deliberate policy to keep that exchange rate high to discourage import and to ensure that we diversify the economy so that the economy can be able to grow in a more sustainable path, and of course ration FX, to critical imports that we also need. So the opportunities exist in the system, possibilities for both greenfield and brownfield do exist, and the central bank and the federal government are partnering to ensure that that happens. So let's go on. So there's been reforms. Latest, of the reforms in the FX market, whereby we have the B-match system, and the B-match system is akin to the IRA window, whereby we saw about, it stopped at about 36% depreciation in 2017, and once the IRA window was introduced, until about the COVID era in 2020, whereby we saw another level of FPI's exit. But we have clarity, ladies and gentlemen. We have clarity in the path the economy is going. The economy of Nigeria is more predictable because the managers are laid all the cards on the table. There are no shocks in the system. FSDH, over the years, we've been able to navigate the system. Our numbers last year shows our capacity to understand the trend line, our capacity to be proactive because of the understanding. And you can imagine how that will even play out for both us and our partners, given the fact that the economy is now more predictable, is now more orderly. The signs and the macroeconomic indicators are no longer shocking in response. Monetary policy is understood, because ordinarily monetary policy must not be shocking, it must be understood, it must be orderly. And that's what we have, because the central bank governor laid his card on the table, told us everything he was going to do, and everything he said he was going to do, he has done them without shocking anybody. So everybody expects that this is how things are going to work out. But let's just run through the slide. I think I don't have a lot of time anymore. So there's reforms. Next slide, please. Real interest rate turns positive. Like I said, monetary policy is now anchored on inflation targeting. What it means is that once you are able to forecast the inflation part, once you are able to know where the inflation is trending, there's a possibility for you to know that this is where interest rates are going. And what they've done is to use the monetary policy tool called open market operations, which is called almost similar to Nigerian Treasury bills, which is a liquidity management tool in the system to guide us as an indicator to where the monetary policy or the interest rate part will lead. And we can see that after a very long time, we have a positive real yield, which means that when you take out inflation from your return on investment, it's become positive. It used to be very, very negative, using the monetary policy as a tool. All I am saying is that the macroeconomy and the outcomes are more predictable. And by being more predictable, that means ability to do business becomes better, because businessmen don't like shocks. They don't like somersault in policies, which this government is working hard to ensure that they do not have somersault in policies. There's policy consistency, and that is what we expect to continue for the remainder of the year and into next year and beyond. Can we go on, please? Go on, please. Go on, please. So public debt. People are concerned about public debt as well. That has grown. But a lot of people do not also heard that growth is a result of devaluation of the currency, particularly from the dollar side or the foreign exchange or the foreign borrowings of the government. But what has also happened, according to the latest World Bank report, gives very high commendation to the government in terms of the way they've managed the resources, in terms of the way they've coordinated policies, and is agreed by everybody, both locally and internationally, despite the pain that an average Nigerian do feel on the street, that the economy is being stirred towards the way it should be stirred. And despite the fact that debt to GDP is high, it's about 53.7, but still within that threshold. The World Bank also did say that debt service to revenue, which used to be above 100%, is now at 40%. Which means that we have more resources for us to be able to do other things and provide that right environment for investors to thrive. Can we go on, please? The tax law, the tax system, like we did mention, a tax expert, a partner at PwC, will come to shed light on that. So financial market performance. Can we go there, please? Okay. I'm not sure where we are right now. Okay, let's go, sorry. Fiscal and monetary policy update, please. Go back. Okay. No, go forward, please. Okay, let's stay here. We're not going to stay here anyway. Because like I did mention, the monetary policy still anchored on the impossible trinity, which essentially, the Naira has been stable, hasn't it? Hasn't it? Relatively. Thank you, Hidi Small. Relatively stable. And that stability is anchored, like I told you, because monetary exchange rate policy is not shocking. The central bank governor has told us exactly what it's going to do. He has anchored monetary policy expectation. Unlike before, we didn't even know what exactly where we're going. We just wake up one morning and, there's confusion and all of that. And that has anchored expectation. That has warmed the hearts of foreign investors. And we can see that they release their pockets, they release their wallets. FPIs, though it's hot money, but we need it. We still need to have it. And we're using it. And even the level of dependency on that hot money, which is FPI, is reducing significantly because the federal government fiscal operations and fiscal activity is more robust as a whole. Ladies and gentlemen, I'm just going to keep talking on this economic report. But the key highlight of it, the key takeaway from the report, is that Nigerian economy is on a more sustainable growth path. All macroeconomic indicators show signs of positive trajectory. Look at inflation rates. It's still high. An average Nigerian, and I will not deny the fact that there's pain. But I think there are necessary pains for us to have a more sustainable economy, for your businesses to grow on more robust grounds, for them to be more rooted, for them to be more firm. Inflation is expected to be about 22-21% to end the year, 2025. Exchange rate, which we'll get into our summary report for our forecast, is expected not to be volatile, to still be around where it is right now, around 1,590. At the time it got to 1,700. At the time it was threatening to touch 2,000. And we saw choppy movements, even within that period, 1,007, 1,006, 1,005, 1,008. But now the stability. So the ability to plan is better. The ability to defend the currency is even bigger. Like I mentioned, net external reserve, where you take out all the owings, the money central bank is owing, swaps, etc., was about $4 billion in 2022. It's now $24 billion as of 2024 and growing. Leakages from subsidy It's been eliminated. People say they can't say it, but they explain that the arrears of NNPC, now that institution needs to be sold eventually, hopefully. But they say the arrears is what they've been using it for. But 50% of that savings have started coming to the system ultimately. Exchange rate, like I said, is going to be stable. Inflation is going to trend down. Interest rates, by implication, anchor the Monetary Policy Committee decision of the central bank and how they perceive the economy in terms of price, stability, both domestic and external price. External price being FX, I said will be stable. Domestic price, which is inflation. It's also good to note that the inflation rate in Nigeria, about 48% of it, is locally produced foods. So people say that inflation, exchange rate is getting higher, why inflation has to go. No, don't be persuaded by such non-economic thoughts. Because the food element in Nigeria, which forms 48% of our inflation figure computation, are locally produced foods. Sorghum, millet, yam, cocoyam, potatoes, and all of the rest. But the problem is insecurity in the food producing areas that makes those food products being unable to get to the market. And once that is resolved, essentially we will have a more, even faster downward trend in inflation rate than we have currently. Let's speed it up so that I can round up. Can we move on, please? So this is money supply, money demand. Essentially, just to mean how much money is in the system at any particular point in time, how much money is in the system will depend on how much FSDH can lend, how much the banking system can give the deficit sector of the economy. Can we move on, please? Can we move on, please? So financial market performance, we'll just skip through the slides. Just a little bit. And you can see, interesting, right? The yield on FGM bond is trending down, which means government essentially is borrowing lower. When the government is borrowing lower, it simply means that the government's financial health is better. That's what it means. Because external reserves growing, inflation rate is coming down, exchange rate is stable, government revenue is getting bigger and better. Wastages in terms of subsidizing foreign travel, medical, tourism, all kind of subsidy is eliminated. And you can see that trend line, which also suggests to us that interest rates are going to go down. If interest rate goes down, I'm sure you agree with me, the business people, even for us at FSD, that is good for business, ultimately. Can we go on, please? Can we go on, please? Let's go on. Because all of this just kind of shows financial market performance, which are indicators that you use to gauge how the economy is trending. And from that trend line, we can be able to have a situation of where should it go? Is it going to go up or is it going to go down? All indication is that all macro data are getting better, and they will get better. And that is the message that we're trying to communicate essentially. So that's about, let's go on, please. For the capital market as well, significant growth. We continue to see inflows of FPIs, FDIs around. So the Nigerian capital market is still resilient. Can we move on, please? We'll get to a point in the meeting whereby we'll further talk about opportunities and how to partner with the public. So macroeconomic projections for 2025, and this is where I'm going to end my presentation. So let's stay here in a bit. So we have different scenarios, assumptions, and our best case is the moderate case. And that moderate case, oil production, which is about where it is right now, it's about 1.47, 1.50 million barrels per day. And if you look at the context of coming from, in 2022 coming from 600,000 barrels per day. And 2024, we're at about 1.5 million barrels per day. You can see the reason why the economy is going to do better and fiscal revenue is better for the government. Moderate reforms reform oil production, GDP, that's what we expected. Inflation, about 21%, like I mentioned. IMF expected to be at 22%. We're a little bit more optimistic. External reserves, to still stay at that 38, it's about 37 billion now. But because Nigeria has about $2.4 billion every year in the next 1 decade, or in the next decade, to pay for maturities of Eurobond foreign borrowings, both the retirement of the bond and coupon payment. So with that, we're just a little bit looking at dynamics and say, okay, give or take, we'll still be about, but still significantly robust. Can finance up to 15 months of import. And IMF said just 3 months, which means we're significantly better. And finally, the final page. These are our macroeconomic indicators. This is where we expect them to end at the end of the year. For monetary policy, we expect it to, MPC, MPR, about 27%. Because essentially, there's the wait and look because of the global economic crisis and the need to be cautious and not to be too ahead of the curve and have to rewind our just policy and become chaotic, which is not good. And I think it's prudent that they have to be that conservative. It's also very interesting when you look at the Treasury bill yield curve. Beginning of the year, when FSDH did pull this out, which is still consistent, even at half year. A lot of people thought it was impossible that we'll be trending towards this lower level yield. But we are around there. I think beginning of the year, we're close to almost 30-something% in some instances for those yield curve. Thank you, ladies and gentlemen, for your time.